The concept of liquidity in banking. Liquidity is a fundamental concept in banking and finance referring to the ease with which assets can be converted into cash without significantly affecting their price. In simple terms, liquidity means how quickly and easily a bank can meet its short-term financial obligations using its assets. For banks, maintaining an adequate level of liquidity is crucial to ensuring that they can respond to customer demands and financial market changes. What is liquidity? At its core, liquidity refers to the ability of an institution to meet its immediate financial needs, such as withdrawing deposits, settling debts, or funding loans. In banking, liquidity is often measured by how quickly a bank can access cash or assets that can be quickly turned into cash. The most liquid asset is cash itself, while assets like property or loans are less liquid because they take longer to sell or convert into cash. Banks deal with liquidity every day because customers regularly withdraw money or make deposits. They must maintain enough cash or liquid assets to cover these transactions, ensuring smooth operations. Liquidity is vital not just for daily banking activities but also for maintaining financial stability in the broader economy. Importance of liquidity for banks. 1. Customer confidence. When customers deposit money, they expect to be able to access their funds when needed. A bank's ability to quickly meet withdrawal requests is critical for maintaining trust and confidence in the banking system. If a bank is unable to meet these demands, it can lead to a loss of confidence and even a run on the bank. 2. Operational flexibility. Banks need liquidity to continue operations and support economic activities. For example, banks lend money to businesses for expansion or to individuals for home loans. In return, they expect to be paid back with interest. Liquidity ensures that banks can fund these loans and support economic growth. 3. Financial stability. A lack of liquidity can threaten the stability of a financial institution. During times of economic stress or market disruptions, a bank may find itself unable to access enough cash to cover its obligations, leading to potential bankruptcy or government intervention. Proper liquidity management helps banks avoid such risks. 4th, regulatory requirements. Regulatory authorities set liquidity requirements to ensure that banks have enough resources to meet their financial obligations. These regulations, such as the Liquidity Coverage Ratio (LCR), require banks to hold a certain amount of liquid assets in proportion to their short-term liabilities. This ensures that banks can weather financial shocks and maintain solvency during periods of financial uncertainty. Factors affecting liquidity. Several factors influence the liquidity of a bank. Type of assets. Assets like cash, government bonds, and marketable securities are highly liquid because they can be quickly sold or used for borrowing. On the other hand, loans, real estate, and other long-term investments are less liquid. Market conditions. In times of financial crisis or market instability, even traditionally liquid assets may become difficult to sell. This is because market demand for these assets can dry up, reducing their liquidity. Deposits versus loans. Banks make money by lending out deposits. However, too many long-term loans or investments can tie up funds and reduce liquidity. Banks must balance their lending activities with maintaining enough cash reserves. Managing liquidity. Banks manage liquidity by holding a mix of cash reserves and easily tradable assets. They also ensure that their liabilities, such as customer withdrawals, are matched with liquid assets. In addition, banks may rely on borrowing from other financial institutions or the central bank in case of short-term liquidity needs. In conclusion, liquidity is a critical aspect of banking that ensures financial stability, customer satisfaction, and the smooth functioning of the economy. A well-managed balance of liquid and illiquid assets allows banks to meet their obligations while continuing to support economic growth and development.